So it's not that the threat is zero, but instead I would say basically there already were several 100,000 coins in these centralized entities. Even, when you take in other things like Coinbase, there's more than that, but there's still the minority. So it's a large minority of coins that are in these kind of big centralized honeypots, and that this might slightly increase them, but not enough. Like if you weren't worried about 15% of coins being held in big institutions, 20% is not going to be the game changer, most likely, right? Or 600,000 coins in ETFs specifically going up to a million or billion point two, right? That's not what changes things.
Bitcoin investors are still very much divided about the spot Bitcoin ETFs and the impact of large Wall Street players like BlackRock controlling hundreds of thousands of Bitcoin. While BlackRock's sudden, largely unexpected interest in Bitcoin has been an issue since last year, more and more people are talking about the risks now that the ETFs have been approved and are voraciously buying Bitcoin. According to data from BlackRock's website, IBIT holds 141,396.45310 as of February 27th. Less than a month ago, as of January 31st, the iShares Bitcoin Trust held 66,200 Bitcoin, meaning it has more than doubled its holding in February. In addition, the world's largest asset manager's spot Bitcoin ETF continues to charge ahead of other Bitcoin ETFs in all metrics. On Tuesday, IBIT recorded its largest daily inflow, hitting a record $520.2 million and a record daily trading volume of $1.36 billion. IBIT's inflows on Tuesday were 5% higher than its previous record of $493.1 million set on February 13th. It also overshadowed the $519.8 million in total net inflows registered for all spot Bitcoin ETFs on Monday. Compared to BlackRock's stunning performance, Fidelity's FBTC came in second with $126 million in inflows, and Bitwise's BITB came third with $18.4 million. Despite the rapidly increasing demand for these products, renowned macro analyst and investment strategist Lyn Alden says there is absolutely no reason to be worried about Wall Street co-opting Bitcoin through the ETFs. Alden believes industry personalities like Cardano's Charles Hoskinson and Max Kaiser, who have raised concerns about these products, may have overblown the risks. During her latest interview with Unchained, Alden also discussed her expectations for the 2024 Bitcoin halving and signs to look out for when we near the cycle's top. As we bring you clips from Alden's interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Thanks, and enjoy the video.
Is there any risk at all with the ETFs, like capturing Bitcoin, or is it an issue if a significant percentage of coins end up in Bitcoin ETFs?
So I think that would have been more of an issue maybe 10 years ago, like when the Winklevoss twins originally proposed a Bitcoin ETF, which was a good thing. I mean, made sense for them to do so. They were early on this whole kind of asset. But if that had happened, you can imagine a case where a lot of the Bitcoins wound up in ETFs. Fortunately now, Bitcoin's had 15 years to kind of distribute. And so it's pretty hard to get the genie back in the bottle and pull a lot of those coins back into very centralized custody. Using GBTC, there was already like 600,000 coins, over 600,000 coins in not an ETF but a trust, basically an ETF for this discussion. And so if you kind of go up to 700,000, 800,000, 900,000, a million, you're still talking about 5% of coins. And so, and the more you get, the more that likely drives price. And that makes it harder to get a bigger share of the network. You can get a more dollar value, but the network value is increasing. And so your ability to keep getting a higher percentage of the network into ETFs is, I think, somewhat limited. So I think we'll see a period where that number goes up, that percentage goes up, because there's years of pent-up demand that, there's all these managed walled garden capital that kind of wants some Bitcoin. So I think when that demand's met, it starts to kind of slow down. The major threat, because it's a proof of work network rather than a proof of stake network, it's not so much about transaction censorship and things like that. The main thing would be kind of determining what side wins in like a hard fork or major owners have a kind of an influence on that sort of thing. There's an economic push that happens. If you weren't worried about 15% of coins being held in big institutions, 20% is not going to be the game changer, most likely, right? Or 600,000 coins in ETFs specifically going up to a million or billion point two, right? That's not what changes things. So overall, I think that risk is somewhat overblown, and I also think that some of the like the no coin or TradFi arguments are Bitcoin is no longer like cypherpunk money because there's ETFs on it, right? But that's a silly argument because Bitcoin didn't decide to have ETFs on it. It's not like the Bitcoin Committee Council got together and decided we're going to have ETFs now. There's no such thing as a Bitcoin committee or a Bitcoin council. Bitcoin is just an open source protocol. And now TradFi has decided to put structures on top of part of it to bring some of it into its own system. All the ETF is in developer terms, basically an API for the fiat system. It just allows the fiat system to plug into Bitcoin a little bit better than it used to. That's all that these do. It's an upgrade to the TradFi system, not an upgrade to Bitcoin, even though it moves Bitcoin price more than it moves TradFi price this cycle. And so that doesn't change the fact that there's other uses of Bitcoin that are more cypherpunk, right? If our parents have Bitcoin in an ETF, right, that's not particularly cypherpunk, but they don't really have a cypherpunk need right now. So they're like fine with that. Whereas I think that, kind of the ongoing battleground will probably be around privacy. So Bitcoin has kind of won the war for like existence. And I actually think it's starting to turn the tide about the whole energy debate. There's a lot of really good pushback on the whole Bitcoin's going to consume all the world energy and boil our oceans narrative. And there's been a lot of pushback on that, both in terms of narrative and in terms of grid balancing or the understanding that it mostly uses stranded energy and it's incentivized to use the cheapest energy in the world, which is mostly energy not being used, right? That is slowly getting into the media, into academia. But I think the battle that's still far from being won is privacy.
While Alden acknowledges that there might be some risks, she sees these products mainly as advertised, helpful tools that will facilitate access to Bitcoin and the digital world, especially for older investors who are more wary of cryptocurrencies and more trusting of traditional investment vehicles like ETFs. The popular analyst also believes more discussion should be had on more pressing issues like privacy and technologies that facilitate faster adoption of Bitcoin in smaller communities worldwide. During her interview, Alden also talked about the coming halving event and how much of an impact it would have on Bitcoin's price. At the moment, the leading cryptocurrency is trading above $60,000, which is less than $10,000 from its all-time high. As we get closer to the halving in April, most Bitcoin investors expect even bigger price actions. While such investors are focused on short-term gains, Alden emphasizes the importance of the halving event in the longer term. Here are more clips from the interview.
I think it's oversold in the near term. Like, there's no strong correlation between the halving and, say, 3-month price action. Sometimes the bull market's already underway before the halving starts. Sometimes the bull market happens after the halving. It's a fairly small percentage of volume overall, and changes in demand can matter a lot more. Where I think the halving really matters is actually over the longer term. Obviously, if Bitcoin did not get more disinflation over time, the price would be much lower. If there were still 50 coins coming out per block, that would be huge. You'd have to have a much lower price in order to absorb the amount of issuance coming. And so it's certainly relevant. And I think the main thing is actually the higher lows in each bear market. The halving is really important for that, because at a time when there's no new marginal demand for Bitcoin, there's some buyers getting out of Bitcoin. The fact that hodlers can basically absorb the supply as the price gets cheaper, they can buy more coins, and now there's fewer coins coming to market than there were in the prior cycles. That's really relevant for having a higher price floor in bear markets. And so I think overall the timing is overdone in terms of narrative, but then obviously the importance is still really there. And I think this is still to some extent affects the timing to a moderate degree. I just think that overall global liquidity indicators tend to be more correlated with Bitcoin price, which makes sense because, the halving determines, a couple $billion worth of annual issuance at current prices, whereas changes in demand can affect hundreds of billions of dollars going in or not going in a given year, for example. I think that's a much bigger factor for timing, but I think the halving is a really important. One, it's important for narrative, and two, it's important for the higher highs and higher lows in each cycle. One of the pictures in your background, like the hodl wave type of chart, I pay attention to that. If you see a lot of longer term held coins coming to market, um, basically, if the price goes up enough, the supply gets a lot more readily available. That can start marking the not maybe not the top of a cycle because it's hard to say where this kind of hits its crescendo, but the risk reward in any given 2-year period starts to get materially worse when that ratio is going down a lot. It's already gone down a lot. A lot of new coins are entering the market. There's a mania. In the last cycle, like when I saw things like Dogecoin going vertical, when just like when just there's kind of just mania everywhere. Because what happens is, Bitcoin is obviously fixed supply and there's lots of demand coming in. But when that demand starts to get very not focused, and when there's all sorts of supply that starts popping up to meet that demand, whether it's like I said, the older coins unlocking and saying, "Hey, you want my coin for $250,000? It's yours," right? Like that, as more coins kind of come to market, as people say, "Well, what else can I buy? I want to buy this coin. I want to buy this coin. I want to buy this JPEG. I want to buy this thing. I want to invest in this overvalued equity building on blockchain XYZ," right? All of that is meeting demand. And there's infinite amount of supply of random stuff that can keep coming to market to meet that demand. And so you start to get closer and closer to the risk of saturating demand for that cycle. And then you have like a bust where people get disillusioned. They bought at the top. It's kind of late money bought at the top, and then you go through kind of a shakeout cycle to get rid of all that excess. And so really that combination of seeing the hodl wave go down and other measures of kind of tightly held coins coming to market, combined with just a flurry of other low quality things trying to meet the overall demand for capital that wants to enter the space and is maybe not that differentiated between Bitcoin and other things that are happening.
Still on ETF-related news, the newborn 9 had a great trading day on Tuesday, according to the latest update from Eric Balchunas. Eric's update reads, "Another intense volume day for the 9, with well over $2 billion traded." IBIT broke its personal record again with $1.3 billion. For context, that's more than most large-cap US stocks trade. I don't know if this is a new normal or some kind of short-term algorithm or arbitrage burst. Also interesting, IBIT saw over 100,000 individual trades today. It was doing 30 to 60K the whole time up until Tuesday. It's like it found a new gear over President's Day weekend. I thought maybe it was just pent-up volume due to the long weekend, but it did even more today. So, there goes that theory. Just like Bitcoin, it would seem even experts don't know what these Bitcoin ETFs will do at any given time. But it is certain that more money is still looking to get in, meaning more rapid demand and further price gains. Is BlackRock good or bad for Bitcoin? Do you think Bitcoin and crypto prices will climb even higher in the coming days and weeks? Please share your thoughts on the video and on Alden's interview in the comments section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.